Strong travel demand and higher room rates boosted second quarter earnings for Marriott International. The company also raised its full-year profit forecast and saw a high rebound in international travel. Let's dive deeper into the quarter with Marriott CFO Leeny Oberg. Leeny, good to have you on Yahoo Finance. Welcome.
Thanks. Great to be with you.
This quarter was China-led. What exactly are you seeing in this market? Because I think a lot of investors have been watching the headlines out of China. They're seeing potential for more stimulus. The economy slowing down, but I didn't see that in your quarter.
So one way to think about this is every part of the world has come out of the pandemic at a little bit different time and a little bit different rate. So you think about a year ago, you saw the U.S. absolutely cranking, and now what you're seeing as China has really relaxed the COVID restrictions, you're now seeing people really be out and about enjoying travel. So while we still haven't seen the same amount of cross-border travel into China yet, 76% has been the traditional amount of travel in China that's generated from domestic travelers. So in that respect, they are all out and about doing group, business, leisure travel in China. And so sure enough, we saw extraordinary growth, more than double in RevPAR.
Are there certain parts of China that are doing better than others? For U.S. investors that may not be familiar with the market.
Yeah, no, I would say overall everywhere, but interesting pieces to your point is Macau in the last couple months has seen an absolutely incredible spike.
Big gambling area.
So we saw, and again, overwhelmingly Chinese visitors. So occupancy over 90% for the last couple months, which in our business is extraordinary. And Hong Kong, while it's still not back as much as mainland China, it's also recovering really nicely. So it's really on all cylinders.
How do the forward bookings look like for China?
Yeah, also really good. So when you think about a group, which you can start to see some visibility out, that's looking strong. Otherwise, our business on the transient side is a fairly short booking window. So things can change quickly, but from the basic pace of what we see, really strong.
Let's get back to the U.S. Are you surprised by the resilience of the U.S. consumer?
No, I'm really not. I think there are a couple things going on. One, I don't think anybody takes travel for granted anymore. It's one of these things where we kind of had come to assume it's always part of life. And I think COVID reminded everyone how much you love to get out for work, for play, for family, drive 2 trips, fly 2 trips, wherever.
I can't stay in my kitchen any longer.
I was going to say, those four walls get pretty tough. So I think that's part of it. But then the other part is, again, this resilience that's coming from leisure came first in a huge wave. But now both business and group are kind of falling in also in terms of big rebounds. And that's really helping support this base level of demand that I think will carry us in the future quite well.
At least for me, I think you had one of the best quotes so far of earnings season on a conference call. I'm a bit of a conference call geek. You said today you see a soft landing. Why is that the case, and what does a soft economic landing mean to you and the Marriott team?
So again, go back to where we were a couple quarters ago, and as you remember, everybody was kind of, expecting that by the time we get to Q3 or Q4, we're looking at a real recession, et cetera, et cetera. What you've seen lately is still really strong employment numbers. Increased expectations for GDP growth. You're also seeing that inflation is calming down, which I think, again, helps everybody think, okay, you know what, we could actually have a kind of a soft landing without a huge downfall. And that, again, gives support for businesses to think about investing. So as they think about going and holding group meetings or going and looking at new projects, when you think there's a bit of a steadier platform to look at for growth, it gives you more comfort about going out and spending that money and sending people on the road. So
then have you seen an acceleration in the number of rooms you're looking to open?
Well, we certainly just added the MGM rooms. So we went from expecting growth in rooms this year of 4 to 4.5% to now 6.4 to 6.7. So that obviously is great acceleration, and we're thrilled with that strategic enterprise agreement. But when I think about the other parts, I would say it's kind of steady as she goes relative to a quarter ago, which is that we are adding rooms nicely. The rooms that are in the U.S. and Europe in particular definitely see the impact of a tougher financing environment. So taking a little bit longer for rooms to go under construction, a little bit longer for them to get financed, but they are getting done. It's just taking a bit longer.
How do you see that playing out? What's the trajectory looking for next year? If the Fed is done raising interest rates, there's, I think, a 19% probability that September that they raise rates, which to me is they're probably not going to do it. What does that mean to your business next year? Well,
again, to the extent that we see a fairly steady environment in the economy, both here and obviously outside is important for us as well, that bodes really well for our business.
We are coming up on another jobs report, and we've talked at length with the Marriott team about it's hard, not just you, it's Hilton, it's all the lodging players, getting the jobs and the people you need to staff those new hotels or staff basic services in the hotels. Where are you at now that the market is slow, job market is slow, maybe some more people out there looking for gigs?
So it has improved. There's no doubt. We actually ended the quarter with about 5,000 job openings.
Still a lot.
I know, but you compare that to pre-COVID, actually was 6,300. So it's actually, we're in fine shape. We are seeing the turnover rates calm down. We're seeing the interest in the industry pick back up. So I would say a much steadier environment.
Is there something that needs to be done to get people into these jobs, new training, new approaches to get this into this industry? Because really, this industry is, you can start on the bottom and very easily work your way to the top over the course of 10, 20, 30 years.
It's one of my favorite things about our industry is that it is all about the people and all about the way they work together. And it is a classic apprenticeship industry where you absolutely, I think about so many of the top leaders at the company, and they overwhelmingly started in, positions like bellman or front desk associates or restaurant associates, and now lead huge parts of the company. So it's a wonderful thing to see. But when you think about kind of what we're doing for the associates, I think the answer is we always want to try to be doing more. It's a core tenet of who we are. Take care of your associates and they'll take care of your guests. But if you think about some of the work that went on last year, increased our match on 401k, started an employee stock purchase plan, really looked hard at labor scheduling opportunities that now are done through an app that's much easier to say, you know what? Next week, because I've got something going on with my family, I really can only work 2 days, while this week I can work 6. A lot more flexibility.
Leeny, you really have major street cred, longtime CFO of Marriott. You're on that Adobe board, really a decorated Adobe board. What are some of the biggest challenges executives like yourself are up against right now?
I would say the one that I probably spend the most time on is speed of change. And obviously technology has a huge amount to do with that. And when you think about how rapidly you see new apps come and go, new businesses come and go, new tech, AI, all the things that are going on with generative AI, it really does reinforce how quickly companies need to be able to adapt. And we're a big ship. We are a big company, and we're working really hard to be as nimble as we can, looking at our markets, looking at our technology, and really excited about what we see going forward.
Does this new technology change the role of CFO? Because in the near term, you have to meet these results, you have to meet Wall Street expectations, but you hear all this new technology and all these investments you might have to make just to do well 10 years from now. I mean, it has to make things more complicated.
Well, one of the things I really have always loved about the CFO role is the intersection between business strategy and capital. And at the end of the day, that is really what it's all about, is devising business strategies that are going to allow you to achieve for your consumer and for your associates what you want, but then thinking about the best way to do that. What is the way that will generate the best returns that allows you to access that capital to make them successful? And it is where those things intersect that, frankly, are no different than they were 10 years ago. The topics may be a little bit different. Technology clearly is only a bigger part of that conversation. But at the same time, it's really all about trying to be successful in your business strategy.